Well, Carol and Alex, do you remember Mad Magazine? Did you read it growing up? I'm not sure if you guys would have. David would have. What me worry? That was the slogan of the magazine, and I'm going to say that's the thing that we want to say about the yield curve today. What? Me worry? There are lots of yield curves, and the one that most people on Wall Street follow is the white line. That's the 2s, 10s. San Francisco Fed and others have said that the 3-month 10-year is the one that you really want to watch. It's the best predictor of a recession. And look what happened. It did go negative on Friday, just briefly, but take a look at this morning. This little yellow line here that says 0.085, it's gone back positive again. That's important. Professor Campbell Harvey of Duke University studied these, and he said a yield curve inversion has to last for a quarter in order for it to predict a recession, not half of a trading session. And that's kind of where we are right now. Now let's take a look at whether the yield curve actually does predict recession. Yes, at least if correlation and causation are the same thing, because yield curves have inverted before the last 7 recessions, but it doesn't mean that a recession is imminent. You take a look at when they inverted before the last 2 recessions, about 9 months before the 2001 recession, and almost 2 years before the recession in 2008. So don't change your portfolio based on the idea that we had a short inversion of the 3-month 10-year, because it doesn't mean that we're going to have a recession right away. It probably means that the economy is slowing. And we already knew that. And finally, there's another thing here that you have to keep in mind, and that is, with apologies to my econ professors, this time it really is different. First of all, the Treasury is selling a lot of T-bills, and that is pushing up rates on the very short end. That hadn't happened before. And also, in previous recessions, in previous times when the yield curve inverted, look at what the term premium was doing. It was way, way, way elevated. But right now, we have no term premium. It's actually negative. And that suggests it's much, much easier to get that 10-year rate pushed down below 0 and have an inversion. It doesn't necessarily mean that we're going to have a recession ahead. The markets are different this time. So what does it all mean? It means that we could, yes, see market behavior based on fear of the yield curve lead us into recession, but it may be that the only thing we have to fear is fear itself. And I might point out, Pat Harker of the Philadelphia Fed this morning, speaking over in London, said he thinks that 1 rate increase this year is still justified.